If you're someone who has spent years saving through SIPs or even building a direct stock portfolio, chances are you're now looking for your next big goal, making your money pay you back. That's where a disciplined income strategy comes into play. Imagine creating a steady, reliable paycheck from your own investments, funding your life in retirement, or helping you achieve financial freedom sooner. The big question though is how to do it without constantly worrying about market volatility or even worse, running out of money when you need it most. In this video, we'll walk you through what is arguably the most effective mutual fund strategy to make that happen. By the end, you will have a clear, actionable plan to turn your portfolio into a monthly income machine. For a long time, the standard options for generating income were things like bank fixed deposits and stock dividends. But these traditional methods come with significant drawbacks in today's financial environment. Fixed deposits, while secure, often provide returns so low they fail to keep pace with inflation. This means the purchasing power of your capital is actually decreasing over time. On the other hand, relying on dividends for a monthly budget can be unpredictable. Dividends aren't guaranteed. Companies can reduce or even eliminate them, especially during economic downturns. This makes it nearly impossible to plan with certainty. So if FDs are too slow and dividends are too volatile, what's the solution? It lies within mutual funds, but it's not about chasing dividend yield funds. It's about a disciplined and automated feature that puts you in complete control. The strategy we're talking about is the Systematic Withdrawal Plan, or SWP. Think of an SWP as creating a personalized pension from your own investments. It's a facility offered by AMCs that lets you withdraw a predetermined amount of money at regular intervals, like every single month. Now, let's walk you through exactly how it works. Step 1. You invest a lump sum amount into a suitable mutual fund. This becomes your income generating corpus. Step 2. You provide instructions to the mutual fund company, specifying how much you want to withdraw each month and on what date. For example, you could set a withdrawal of 40,000 rupees for the first of every month. Step 3. On that date, the fund house automatically sells just enough units of your investment to generate your 40,000 rupees and transfers it directly to your linked bank account. Now, here's the crucial part. The rest of your money remains invested in the fund. This remaining corpus continues to have the potential to grow, which can make your savings last significantly longer. An SWP isn't a product, it's a feature, a systematic way to generate cash flow while allowing your underlying assets to appreciate. You might be wondering if this is any different from just selling units yourself when you need the money. The answer is yes, and the disciplined approach of an SWP is what makes it a superior strategy. First, it delivers a predictable and consistent cash flow. You set the amount and the frequency, and the money arrives like clockwork. This is essential for managing your monthly budget, particularly in retirement. Second is its flexibility. Your financial needs can change, and an SWP can adapt. You can start, stop, or adjust the withdrawal amount as your circumstances evolve. If you need more income to counter inflation, you can increase it. If you have a temporary source of other income, you can pause it. You are in the driver's seat. Third, and this is a key advantage, is tax efficiency. When you withdraw through an SWP, the amount is a combination of your principal and capital gains. You are only taxed on the gains portion. For equity funds held over a year, this treatment is often far more favorable than having dividend income added to your income and taxed at your slab rate. Also, there is no tax deducted at source for resident individuals, which improves your in-hand cash flow. Finally, your capital continues to have growth potential. Because your entire corpus isn't sitting idle, the remaining investment can grow. If your fund's returns are higher than your withdrawal rate, your investment could last indefinitely or even increase in value. This is the key to making your money last. To better visualize this, let's run through a quick example. Imagine you have a corpus of 50 lakh rupees invested in a fund that generates an average annual return of 7%. If you set up an SWP to withdraw 40,000 rupees per month, That 50 lakh rupees corpus could provide you with income for nearly 18 years. But if your monthly need is lower, say 30,000 rupees, your money could last for over 25 years. The real magic happens when your withdrawal rate is below the fund's growth rate. For instance, a 7% annual return on 50 lakh rupees is 3.5 lakh rupees, or about 29,000 rupees a month. If you withdraw less than this, let's say 25,000 rupees a month, your corpus will not only fund your expenses, but will also continue to grow over time. You are effectively living off the returns, not just eroding your principal. I'd recommend using an online SWP calculator to run these simulations with your own numbers to plan effectively. Once you've decided on the strategy, your focus shifts to selecting the right mutual fund, because the success of an SWP heavily depends on this choice. The goal here isn't to chase the highest possible returns, but to find a balance between stability and reasonable growth. The last thing you want is for a market crash to force you to withdraw capital at a loss, as that could deplete your corpus much faster. For most investors, particularly retirees, the best fund categories for an SWP are conservative hybrid funds. These are often considered the gold standard for SWPs. They typically invest about 75% in debt instruments for stability and 25% in equities, which provides the potential for growth to beat inflation. Balanced advantage funds. These are dynamic funds that adjust their equity and debt allocation based on market valuations. They reduce equity when markets are expensive and increase it when they are cheap. This active management helps protect the downside, making them a very smart choice for income generation. Short duration debt funds. If your primary goal is capital preservation and you are extremely risk averse, these funds are a solid option. The returns will be more modest, but the volatility will be very low, ensuring your SWP is highly dependable. The key is to match the fund's risk profile with your income needs and risk tolerance. For a long-term income plan, a hybrid fund is often the most sustainable choice.
Now, to better understand why SWP is often preferred, let's do a quick comparison with the dividend option that many investors consider for income. Predictability. With an SWP, you determine the exact cash flow. You get a fixed amount on a fixed date. Dividends, on the other hand, are at the discretion of the fund manager and can be unpredictable. Taxation. This is a major differentiator. With an SWP from an equity fund held for over a year, long-term capital gains up to 1 lakh rupees are tax-free, and gains beyond that are taxed at 10%. As for debt funds, the taxation rules have changed, so it's wise to consult a tax advisor. However, dividends are always added to your total income and taxed at your marginal slab rate. For anyone in the 20 or 30% tax bracket, the SWP from an equity fund offers a clear tax advantage. Flexibility. An SWP gives you total control to start, stop, or change the amount. With dividends, you have no control over the payout. In every key metric, control, predictability, and tax efficiency, the systematic withdrawal plan comes out on top. So, if you're ready to set up your own monthly income machine, let's walk through the steps. Step 1. Assess your needs. Before jumping in, evaluate your financial goals and determine exactly how much monthly income you need. Be realistic and remember to account for inflation over time. Step 2. Choose your fund. Based on your risk tolerance and the fund categories we just discussed, select a suitable mutual fund. Look for schemes with a consistent long-term track record and a fund manager whose philosophy aligns with your goals. Be sure to read the scheme information document. Step 3. Complete the SWP registration. Once your investment is made, you will need to fill out an SWP form, which can usually be done online via the AMC's website or platforms like CAMS and KFintech. You will specify your folio number, the withdrawal amount, the frequency, and the start date. Step 4. Link your bank account. Ensure your primary bank account is correctly linked and verified so that the monthly transfer happens seamlessly. Step 5. Monitor and review. An SWP is not a set and forget tool. It's crucial to monitor your portfolio's performance at least annually. Market conditions or changes in your own life might require you to adjust your withdrawal rate to ensure your plan remains sustainable.
The Systematic Withdrawal Plan is not just another feature, it's a gateway to turning your hard-earned investments into a structured, flexible and tax-efficient monthly paycheck. It puts you in control, allowing you to customize your cash flow to fit your life. But remember, the success of the strategy depends on choosing the right funds and setting a sustainable withdrawal rate. Do your due diligence and make sure the plan aligns with your long-term financial stability. So what do you think? Are you ready to explore an SWP to generate income, or do you prefer other methods? Drop a comment below and let's discuss. And if you want a deeper dive into how to select the perfect hybrid fund for an SWP or how to calculate a safe withdrawal rate, let me know and I'll cover that in an upcoming video.